Bitcoin just crossed back above $80,000. And with institutional adoption accelerating faster than ever before, the question on everyone's mind isn't whether crypto matters anymore. It's what happens next. Welcome back to the channel. I'm your host, and today we're doing a comprehensive educational breakdown of Bitcoin, ticker symbol BTCUSD, the original cryptocurrency that launched an entire asset class and continues to dominate headlines across traditional finance and tech media alike. With a current market capitalization of approximately $1.64 trillion, Bitcoin now rivals some of the largest companies on the planet in terms of total value. To put that in perspective, that's larger than the market cap of most major banks combined. Whether you're a curious observer or a seasoned market watcher, understanding what's driving Bitcoin's movements has never been more relevant. Let's dive into the data. The cryptocurrency landscape in 2024 has been defined by several watershed moments that have fundamentally shifted how traditional finance views digital assets. First, and most significantly, the approval and launch of spot Bitcoin ETFs in the United States earlier this year marked a turning point. Data shows that these exchange-traded funds have accumulated tens of billions of dollars in assets under management within just months of launching. Major asset managers, including BlackRock, Fidelity, and others now offer Bitcoin exposure through regulated, traditional brokerage accounts. This development removed significant friction for institutional investors who previously faced compliance hurdles when considering cryptocurrency allocations. Second, the Bitcoin halving event occurred in April 2024, reducing the block reward for miners from 6.25 Bitcoin to 3.125 Bitcoin. Historically, halving events have preceded periods of significant price discovery, though past performance, as always, does not guarantee future results. The halving fundamentally alters the supply dynamics of new Bitcoin entering circulation. Third, we've observed continued corporate treasury adoption. Several publicly traded companies have added Bitcoin to their balance sheets, treating it as a reserve asset alongside traditional holdings. This corporate adoption narrative has added another layer of legitimacy to Bitcoin's role in diversified portfolios. The macroeconomic backdrop also matters significantly here. With central banks globally navigating inflation concerns and interest rate decisions, Bitcoin's fixed supply schedule of 21 million coins maximum has renewed discussions about its potential role as a hedge against monetary policy uncertainty. Now, let's address the significant risks and challenges that any objective analysis must consider. Regulatory uncertainty remains Bitcoin's most significant headwind. While the United States has made progress with ETF approvals, the broader regulatory framework for cryptocurrencies remains fragmented globally. Different jurisdictions have taken vastly different approaches, from outright bans to full embrace. Any major regulatory shift in key markets could significantly impact adoption trajectories. Volatility is another factor that cannot be ignored. Bitcoin's price swings, both up and down, historically exceed those of traditional asset classes by substantial margins. The current price of approximately $81,800 represents just a snapshot in what has been an extremely volatile journey. Even today, we're seeing a modest decline of about 0.37%, but daily moves of 5 to 10% are not uncommon in this market. Competition within the cryptocurrency space itself presents challenges. While Bitcoin maintains its position as the largest cryptocurrency by market cap, thousands of alternative digital assets compete for investor attention and capital. Ethereum and other smart contract platforms offer functionality that Bitcoin's base layer does not. Environmental concerns around Bitcoin mining's energy consumption continue to generate debate. While the industry has made progress toward renewable energy sources, this remains a consideration for ESG-focused institutions. Finally, technological risks, including potential security vulnerabilities, quantum computing threats in the distant future, and the concentration of mining power in certain geographic regions all warrant consideration. Let's look at the current market data for Bitcoin. As of this recording, Bitcoin trades at approximately $81,836 per coin. The total market capitalization stands at roughly $1.64 trillion, making Bitcoin the dominant cryptocurrency by a significant margin, typically representing 40 to 50% of total cryptocurrency market value. Unlike traditional equities, Bitcoin has no price-to-earnings ratio because it generates no earnings in the traditional sense. This is a fundamental difference from stock analysis and why many traditional valuation frameworks simply don't apply here. Instead, analysts often look at metrics like the stock-to-flow model, network hash rate, active addresses, and on-chain transaction volumes to gauge network health and adoption. The current hash rate, a measure of computational power securing the network, sits near all-time highs, indicating strong miner commitment despite the recent halving reducing their block rewards. This suggests miners remain confident in the network's long-term viability. Trading volume across major exchanges remains robust, and the introduction of spot ETFs has added significant new liquidity channels. The bid-ask spreads on major trading pairs have tightened considerably over the years, indicating improved market efficiency. Now, let's explore potential scenarios over the 1, 2, and 5-year horizons. I want to emphasize, these are analytical frameworks, not predictions. In a bullish scenario, continued institutional adoption could accelerate. If sovereign wealth funds, pension funds, and additional corporate treasuries allocate even small percentages to Bitcoin, the impact on a relatively illiquid asset could be substantial. The ETF infrastructure now exists to facilitate such flows. Additionally, if global macroeconomic conditions favor hard assets, whether through persistent inflation, currency instability, or geopolitical uncertainty, Bitcoin's narrative as digital gold could strengthen. In this scenario, analysts have noted that Bitcoin could potentially challenge previous cycle patterns and establish new price discovery ranges. The base case scenario suggests continued gradual adoption with significant volatility along the way. Bitcoin has historically moved in cycles, often correlated with halving events. Under this framework, the asset would continue its pattern of dramatic advances followed by substantial corrections, ultimately trending higher over multi-year periods as network effects compound. Regulatory clarity, while not uniformly positive, would progress sufficiently to maintain institutional participation. In a bearish scenario, several factors could pressure Bitcoin significantly. A major regulatory crackdown in key markets, a significant security breach or technical failure, the emergence of superior competing technologies, or a broader risk-off environment could all negatively impact prices. Bitcoin has historically experienced drawdowns of 70 to 80% from peak to trough during bear markets. This is documented market history, not speculation. The key variables to monitor include regulatory developments globally, institutional flow data from ETF products, on-chain metrics showing actual usage patterns, macroeconomic policy decisions from major central banks, and the competitive landscape within the broader cryptocurrency ecosystem. It's worth noting that Bitcoin's role in portfolios is still being defined by traditional finance. Whether it ultimately functions as digital gold, a risk-on technology asset, a currency, or something entirely new remains an open question that markets are actively debating. To summarize what we've covered today, Bitcoin sits at approximately $81,800 with a market cap of $1.64 trillion, making it a significant global asset by any measure. The 2024 spot ETF approvals and halving event have reshaped the market structure significantly. Major risks include regulatory uncertainty, extreme volatility, competition, and technological concerns. Multiple scenarios exist for Bitcoin's future trajectory, and responsible analysis requires considering the full range of possibilities. Understanding these dynamics is valuable regardless of your personal views on cryptocurrency's long-term role in the financial system. If you found this analysis valuable, hit that like button and subscribe for weekly deep dives into the assets shaping global markets. Drop a comment below with what asset you'd like me to cover next. For educational purposes only. not investment advice.